All opinions expressed by the Kendall Report participants are solely their opinions and do not reflect the opinions of VPM Partners, and may have been previously disseminated by them on television, radio, internet, or another medium. You should not treat any opinion expressed on this broadcast as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of an opinion. Such opinions are based upon information that the Kendall Report participants and Robert Kendall consider reliable, but VPM Partners does not warrant its competence or its accuracy, or should it be relied upon such. The Kendall Report participants, VPM Partners officers, directors, employees, contractors, guests, are not under any obligation to update or correct any information on this broadcast. The Kendall Report participants are professional traders or investment advisor representatives who may be actively involved in securities herein on behalf of themselves, their companies, and their clients. Also, the opinions expressed by the Kendall Report participants may be short-term in nature and subject to change without notice. No part of the Kendall Report participants' compensation from VPM Partners is related to a specific opinion they express. Past performance is not indicative of future results. Kendall Report participants and VPM Partners do not guarantee any specific outcome or profit. You should be aware of the real risk of loss and following any strategy or investment discussed on this broadcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned in this broadcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this broadcast. Before acting on the information on this website, you should consider whether it is suitable for your particular circumstances and strongly consider seeking personalized advice. Nothing contained in the Kendall Report broadcast or VPM Partners on its website or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by any particular security, other investment product, transaction, or investment. Copyright 2017 VPM Partners and the Kendall Report, all rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic media in whole or in part is prohibited under penalty of law.
Now, for your host, Bob Kendall.
Welcome, everyone, to the Kendall Report for November 5th, 2018. Down to the last 2 months of the year. Hard to believe, huh? And this stupid time change. I just hate it because we don't switch our clocks here in Arizona, so I have to change everything. Felt like forever before the show was going to start. It usually start at 9, and now it's 10. So anyway, hope you guys are all doing well. And there's a number of things. This is a pretty big week we've got coming. We've got the Fed, which is going to be a non-event, maybe a few words in their release that they might have out that might have some significance. But we got 1,226 to be exact earnings reports. We've got, plenty of, we'll go through here in a minute, the economic releases. And so there's a lot going on, and not to mention, or forget to mention, the midterm elections tomorrow. So we'll see how all that plays out, see what kind of emotion comes in. I think everybody's pretty much, just in a neutral mode right now. And so what I'm going to do, let's go ahead and talk a few minutes about the reports that are coming out this week. There's nothing today to PMI services and ISM manufacturing. No big deal there. There is a bit of a bid in the markets today. Tomorrow is a nothing day. Wednesday starts the FOMC meeting, which is just kind of a ceremonial thing that happens. And then we've got consumer credit, nothing. Thursday is pretty good size. This is where the FOMC announcement will come out. And like I said, people will be parsing words and looking what changed from the last one. But for the most part, not much is going to happen here. And then, consumer sentiment on Friday. So overall, economically, there's not a lot except for something the PPI comes out on Friday, which I believe will be significant. I think early next week we'll see. Let me just spin over here real quick and just see what we've got coming out. Of course, we got Veterans Day. We got a short week next week coming. And nothing there that I thought might be out there. So the next couple of weeks, other than earnings, it's going to be pretty light as we look at all this. There's not a lot that's going to be going on as far as I guess economics and all that goes. So we'll be down to talking about some kind of emotional event that happens around this election. It's so emotional out there and so polarized. So make sure you get out and vote, whatever you're doing. That's going to be pretty important. Let's go ahead and kick into the technical part of the show and just start taking a look at some of the technicals. And one of the things I was talking about, and I believe I have it up. Let me just go over here. Let's come over here, and I want to just bring up this chart here, because this is what I've been talking about. I'm talking about this ABC pattern that's going to be unfolding. We finished we should have 3 days down, and I'll show you here in a minute. What we're having today is an inside day, which is pretty typical after a big outside day like we had on Friday. But this is the pattern I'm expecting. We should see market bottom out tomorrow and then start a rally, and we could go, and as I talked about in commentary, the range on the upside right now, if I come over here, we're looking at probably 20. I'm hoping to see 27.85. Let's go back to the live graph so you can see this. There's something here that I think is important to pay attention to, and this is, there's a gap in the charts on the cash charts, which is reasonably unusual to happen, and it's right here. I'll just put a little bubble right here. This is a gap between 26.85 and 27.05. We got down on Friday down to 27 even, and we haven't been close to that today. We've been just kind of holding up, and this is a 30-minute graph. So, but that's the magic target there as far as the patterns go. And we go back to the daily graph here, and we go back to the daily. You see that same gap over here on the right-hand side. Let me pull this over just so we can get a little chance here. But this, we should have one more day kind of trading within the range, not getting above the highs of Friday, which was, let me just bring that up. Friday's high was 27.56, and we shouldn't get much above that, obviously today or tomorrow. But on Wednesday, Thursday, Friday, I'm expecting to see the markets move up. So I don't know what that means. I have no idea how the reaction is going to be to the election. We don't know what the election is going to be. So it's going to be even, it's uncertain. So the bottom line from a technical standpoint, we should have one more day with the downside. We should get 3 to 5 days up. Typically, we're going to get 5 days up, and that should be how this pattern unfolds. And I think I may have drawn up some things. There are a couple of things I want to show you that important here. Let's go ahead over to the weekly. And this pattern is actually accelerating on the downside. We're not really seeing any uptick in the PPMs here. You'll see PPM 1 is at minus 0.61. And that's, you can see it over here on this scale, minus 0.61. And you'll see this pattern. I'm going to use a tool that I forgot to use last week, but I think this will help you to see this graph over here, and you'll see the pattern is upsetting. The 40 period moving average is flattened out. The 10-period moving average is down. This is telling us that this downtrend is likely to continue. I don't see us right now. The 10-month moving or week moving average is at 28.15, and it's not likely to be penetrated in that current level as far as the patterns go, because I talked about the PPM is at 0.61. The probability of the market staying above that number is around 20%. So literally the new calculation here, 28, 15, 14. The interesting thing of that, I guess, is if we look at the high of this session here, you'll see the high on this week here was 27.34, and if we go all the way over, this is the big number, 2816.94. That was the high of the inside bar on a weekly that I talked about several weeks ago. And what this tells us is that is going to be the key pivot number on the charts, and the probabilities with these PPMs like this are almost nil that we're going to get above that level. Now, if we were to stay in a range, stay above 2,700, let's say for the next 2 weeks, and consolidate, then a lot of this downside volatility would bleed off, which would tell us that there would be a probability to get above that level. But I don't see it getting above that 28.16 level during this pattern. So we'll go ahead and take a look at the monthly graph here, and this is even more evident. It's interesting, and I've talked about this a fair amount, is that the PPM 1 on the monthly graph, or the 10-month moving average, is now declining by 1/3% per month, 0.35. This is the first time we've seen anything like this since 2015, early 2016. And this is also in a much different position than what we've had before, in that we now expanded to a all-time new high, and then shortly after making the new high, we saw the markets implode. And the implosion was about the same magnitude that we saw on January 26th, but the pattern is much stronger to the downside. And you can see all of the PPMs over here on the right. I'll move my cursor around here. All of these PPMs, including the one on the 200-month moving average, everything's rolled over, penetrating its first and second derivative, which tells you this is most likely the beginning of a larger trend that's going to unfold. So one of the questions I had talked about was, you know, when does a short-term correction end up to be a bear market? And this is part of the formation. I talked about this on a couple live broadcasts that I did last week, but we bounced at that 20 when we went down to, I'll show you this number right here, 2603.54 was the low. The moving average then, the 10-month moving average was 21-month moving average, 2614. So we bounced right off of that average. That is going to be the parameters I think we're stuck in. The extreme is around 2778 to 2614. And I'm going to show you something that kind of illustrates this pretty good. Let me make this full screen, and I'll come back full screen here in a second. Let me get to a monthly graph, and you'll see exactly what's setting up here. What's setting up here is you can almost see the definition of the pattern. 2889 to 2533 is the huge range that we're likely to stay within. And there's a couple things going on here. What this chart is the VPM, in this case, not the 3-day, but the 3-month volatility indicator. Each one of these ranges that are up here are, you can see here, the 28.89.50 is the extreme. And then R1, we're most likely going to stay, I suspect, between R1 and S2. So we get 26.22, R1's 27.53. So if it's going to be important, I think, that we fill this gap on this downward sequence right now. If we don't, and we go up toward this 27.53 level, which is going to equal where we got up to last week. Matter of fact, 27.56.55 is the high of last week. If we get back up to that level, then we're going to have lots of resistance. There's a number of things happening there. You can see this is a monthly graph. Let me just put on the daily real quick. You'll see the same kind of range. We're kind of range bound right now, 27.63 in the top end, 26.83 in the downside is the current range, and this is where we're likely to stay in. If you notice, and just looking at, let me take this off screen here. If you look at these things, very seldom does the market break out of these bands. And what these are, looks at a 3-day volatility, and then it takes and calculates a series of Fibonacci projections for each day. And that's when you look at the expectations for the ranges of each day. This is the calculator that does this. This is something I worked on for a long time, and I finally automated it. I used to do this all manual, and I finally put a process together that there's an indicator that does this. And we can see right now, if we come up here in this on a daily graph, the ranges for today, 27.34.28. R1 is 27.32.51. The next level, 27.43. And on the downside, we didn't quite hit S1. So far, we're trading basically in the confines of R1 and S1. And the concept that I use here is that each one of these bars overlaps. And when you get a range like we saw Friday, where we had an outside bar, we needed to close under 27.22 to signal a downward reversal. We closed at 23. It was close, but not good enough. So now what we're seeing is an inside day of the outside day, which is pretty typical. You can see we had that same kind of bar over here. I'll just highlight this right here. In fact, let me just do something real quick just so we can make sure we're all on the same page. So this bar right here I'm pointing to is the outside bar. And then we got an inside bar here. Now we got another outside bar and an inside bar. The difference is this outside bar is at a top, this inside. So therefore, the probabilities are that we're going to move down toward this 26.83 level, and possibly tomorrow. And like I said, I don't know if it'll be the midterm elections that will cause this. I'm not sure what will trigger this event, but that looks like to me exactly how this pattern is going to play out. And just real quick here, as I go over and take a look at this thing and go over to a weekly graph, you'll see the weekly mode. This is probably going to define the pattern that we're going to be in this week much better. And you can see now we're 28.46, and on the downside 25.99. So this pattern is setting up. We had a bit of a weekly reversal, and if we cannot take out the high, which I talked about earlier when we were looking at the daily graph, if we can't take out this high here, this one right here, you're going, which was 27.55. If we can't take that high out, then we're going to stay within the confines, and we're probably going to have an inside week. And if we look at the expected range, if we look at what the VPM range indicator is showing us here, is the R1 is 27.52, S1 26.93, which puts us right at that pivot. So I don't, I talked about in commentary that we're going to see some kind of massive volatility, but maybe not. Maybe we're going to be locked in this 50 or 60 handle range. We've been seeing trading sessions with 75 one day. When we hit 2603 that day, we saw a 100-point range that day, which is pretty phenomenal. And we're not talking about the Dow Jones, we're talking S&P. So this is pretty phenomenal as far as the markets go here. So let's go ahead and go back over to the monthly graph as we look at this. And this is pretty significant because we did not see, if I go back over to this level, let's look at when we rolled over here. This is just trying to get a number on PPM1 here real quick. PPM1 did get down to minus 0.72, so it was a little weaker in January. We're currently 0.34, but I really think we're going to see this thing move down toward, like I said, retest of, there's no way we're not going to retest the 2600 level. That's just not going to happen. That's going to be in the cards, but it's going to be probably after we run to at least a challenge 2755, possibly going to 2778. Okay, so let's take one more. Let's go and start to look at some of the other indexes, and I think this is important as well as the composite. Let me go down to the daily. This has actually been the leader. We also have that gap. If you see where my cursor is, we have that gap. Let me just bring up the magnifier just so you can see that. The same thing you'll see right right there, there's a gap on the NASDAQ as well. And the pattern it's unfolding is a little bit different, has a little more bias to the downside from on a daily chart. So I think the NASDAQ is going to lead us down to fill that gap probably tomorrow. And then once that's filled, then we can start to see another rally up. And let me just grab this and pull this over here and do some drawing here. So this would be the expected pattern. We get this first leg up, which is complete. We're working on the B leg, and then we should come up. And while that's happening, we should see we'll just say that this 20 or 40 period moving average should come here. We should bounce off of that. And the downside on this is minus 0.20 and minus 0.32 and minus 0.25. Every one of these, with the exception of PPM3 right now, is in trend mode. So that tells us that all trends are down. We could see a little flattening here, and then we'll go up. Now, the interesting thing is, I think this will work. When we were over here, where I'm putting this spot, we saw something very different. And what we saw during this period, after the big spike, we did see basically the ABC, right? And then we had this huge decline. And this pattern here was dominated by a couple things. I'm just going to go ahead and draw this out here. But it was dominated by this 200-day moving average moving up underneath there. Well, On the composite, it's still slightly positive, so it's coming through over here. Looks like 75.18, so we're a fair amount. So as in the S&P, I'm expecting to see this thing bounce up and hit this 40-period moving average, and then the next event should be, on a bigger scale, it should look like this. And this could end up to be the wave 4, and then wave 5 will take us down here, somewhere in this range here, down around 68, 6,900. This pattern is almost of high certainty. Now, in the past, I guess to draw in the alternative pattern would be something that went like this, and then you get a setup, and then, you know, we get some kind of a pattern where this thing could go to a new high. Not sure what would do that. A lot of folks would argue that maybe a deal with China would do that. I'm not sure about that. But I really think that the first pattern that I showed you is going to be the most likely pattern to unfold. You know, there's so much going on as we wind down into year end. After the elections are over, I think we're going to have a much clearer view. The Fed's going to continue to raise rates. They're not going to back off. If they back off, it'll scare everybody. They're going to stay on track. The employment numbers came out last week, another 250. Unemployment on change at 3.7. The whole scenario that continues to happen is bullish underlying from the economic viewpoint, but it's not, you know, I keep arguing that the economy is not the markets, and the markets have hit some sort of peak, and maybe today we'll take a look at Apple and some of the others. We're going to go through interest rates next, and maybe we'll take a look at some of these FANGs. But the bottom line is that we're not seeing the type of, I guess, activity that is going to tell us that this is the likely scenario where we're going to make new highs. All of the PPMs, the database, the VPM database below 11%, all of this stuff matters. Okay, so let's go and take a look. Speaking of the VPM database, let's go ahead and take a look at that and just get a feel for what's going on within the database. So you'll see we had virtually no activity. There's sell orders 679, buy orders 107. We had a slight negative again. We were around 11 point something on the percent bullish. Now we're below 10 just by a little bit. You see equities are at 32.81, ETFs at 21.24, and mutual funds at 12.16. So there's really the patterns that we're seeing here are pretty actually stable from where we've been. So the equities are hanging in there. Typically, if you have an equity strategy, you're probably anywhere from 40 to 60% in cash. As you know, if you're in most of the index strategies, you're probably 100% in cash. And like I said, that while the entire analysis that I've been doing today is negative, it may be that we just are eliminating volatility right now. That's all that's happening. You know, so a lot of times people go, oh, VPM thinks the market's going down. What it thinks is that the market's not going up. Doesn't mean that it's going to go down a lot, but it does appear that we're completing a pretty major cycle as we were just discussing. So let's go over and take a look at VPM 2.0. We'll go over there, take a look at a couple things in here. Here's the 10.91%. That is, let me just do this a little bit here. There it is, 10.91% bullish right now out of 17,761. We only have 1,937 symbols long. Utilities is the only sector long. And in the groups right now, we're down to 13%. So we only have 14 groups long as well. And if we went over here and clicked on groups we will see which groups are long. There's some pretty good ones. That's interesting. Jewelry and silverware up 69%. It's been on for a long time. But you can see here most of these have been on for at least, well, this electric utilities, which came in with utilities, that's down a little bit. But the bottom line is all of these groups that are long are pretty profitable and have been trending for a while. And you can see a number of things that are going on in the groups that are pretty positive, the ones that are left. But like I said, it's 13.73%. And from a standpoint, if we go over to the home page here real quick, and we start to look at the percent bullish and where it's been, you make this just a little bit bigger here. I think there's something real revealing here, and this is continues to be why I have such a negative view. So you'll see a couple of things here. While the market was going before this peak, you'll see that this was about midway, which is pretty typical, that the most traction we got was a little bit about 72, 74% bullish at this time. Happened midway around 2017. This last leg, we started to see this. That every time we made a new high, we had fewer items actually participating. All the way to this point where we only got to 52% as we got up near the high. And then we started to see this. You can look at these bars. They just started down ticking here. Sorry, I accidentally clicked on. They just started down ticking. Once this high was put in, then they just down ticked all the way down until we're at 10.9. You can't see it on this scale here, but this thing has just collapsed. And I've talked about this in great detail over the last several weeks, in that I've not seen it collapse quite as fast and down to the level. You can see if I draw a line here around 20%, and I'll just do 25 roughly. You know, we come down in this range, but this is where rebounds happen. When you exceed this 20% range, we get all the way down to 10. I suspect we will see some buying if we get the pattern I was talking about, where we'll start to see some minor traction, and mostly will be on individual stocks. I doubt if any of the key indexes, SPY and MDY and those type of things, come into play. We're not likely to see that happen much. So this is going to stay. My guess is we will stay. I'm going to clean this up a little bit so I can talk about this. The magic mark that I talk a lot about is around 42%, and then the other downward mark is 20. So if percent bullish is staying in this range, then this is negative. Above this range, when we're above here, this is positive. So you can see we cracked right here. This is something I talked about when the January 26th high came in. And this was the patterns that were unfolding. So we went below this line here. We rebounded on this last rally. So we did get some traction, but there wasn't a lot of money to be made. And so the event was that we have this, basically you got these declining top type scenario. And I suspect, boy, I got a lot of lines here. Let me clean this up. You've got these declining tops coming here and then here. And I suspect we will stay well below the magical 42% line for a while, which will keep the markets negative. So let's take a look at, let's go back over and take a look at the Treasuries and go through that scenario. We did see a pretty good move up in the Treasuries last week. We're getting basically what I call inside bar, just like we're getting on the markets here. Momentum was looking pretty strong as we came into this session, but with the markets down, everything's turned down. PPM2 is flat. PPM3 is still up. So this, where you can see my cursor up here, that is going to be the key support. And that number is 3.10. So actually we'll call it 311. It's 3.109. So 311, I talked about this before, around 312. That was the old high, by the way, 312. And somewhere around 325 is going to be the magic mark there. I drew a chart here. Let me just see if I can bring this up real quick. So this graph here is the 10-year Treasury, and this is what I'm looking for. And this will probably be the first quarter of next year. And that'll be, we're looking at 342 to 362. And there is a number at 384 to 410. And we're going to continue to move up to this target range. And this was the weekly graph here. And I'll go and show you this on real-time mode. But you can see all the PPMs are turning up. Everything is very positive. You got the 10-week moving average under here, but that's the initial target for this market. And you'll see here, let me go over to the weekly and you can see that chart. And let me pull that back so you can see that just a little bit. You can see that PPMs are maintaining plus 1.09, plus 0.42, and 0.29, all positive, all trend mode. And the PPM1 is just really, really strong underneath the market here. So we're looking at that average, 311. So there's that number again where you've got all of the configuration, the 40-day, the 10-week, and we'll go over to the monthly here. And the monthly is trading right at this resistance line that I talked about for a while. This is the 200-month moving average, but let me bring that up so you can see that. So that is 320. So we went above it a little bit. Above that 320, then you're going right to the numbers I just talked about. So let's take a quick look at the yield curve. Bring up my favorite yield charts. You can see everything started to surge. We continue to see, we've stabilized a little bit on the 13-week T-bill, but this is still in basically a narrowing type pattern. You can see here, this is going to reflect that right here, where we've seen it start. It started to steepen for a while. Now we're back narrowing, and I suspect that we will continue to narrow sometime into early December. We should see that turn around. But all of these, whether you're looking at, the good news is the 1030s are steepening, the 530s up here are steepening. Or this is the 1030s here. All of the intermediate maturities are steepening, which is good. The only flattening is in that shorter end of the yield curve because the short end is still moving faster than the 2-year. This is the 2-year versus a 13-week. And that's why we're seeing that. So we're going to continue to see that just by what the Fed is doing there. So let's go ahead. And by the way, at this stage of the game, I would entertain if anyone has a question that's watching, go ahead and just go into the chat area. And if there's something you want me to cover, please ask the question. So let's go over here, take a couple looks at some things here. We did see a buy come out on the EEM daily out of this sharp formation down. And I talked about this a few weeks. I'll bring this up in 2.0 here in just a minute. But we did have a series of losing trades. This pattern is, I guess we'll just call it the perfect storm. Every time we got up here, we'd get a failure. And then we'd get another rally, and then it would fail. Another rally and fail. Well, this has been going like this all the way down in this sequence. So it's been stair-stepping. And this is really interesting because here's the lows in February. Look what's been going on in emerging markets. And that has a lot to do with the dollar I'll cover in just a minute. But the pattern that keeps happening is this whipsawing action where it's just stair-stepping down, gets enough upward movement, looks like the trend is bottoming, and then it will fail again. And we just got another buy the other day. I think if I bring this out, let me just put this strategy up. Yeah, there's a buy 3 days ago, but you can see this is buy, sell, buy, sell. You know, here's another. They're all pretty small losers, but they're pretty irritating, and they're just grabbing. The fact is that a lot of these trades are coming in at 31% on like global equity 4. So 1% is most of them were 0.5% or so, but it's just been chipping away at the equity. It's been very frustrating. And after that many trades, I suspect we're going to see this one finally start to work. And you know, this is we have and I believe I need to change this out because we have 3-2 on here. Let me get rid of this. This platform will let me put both models at the same time. Yeah, here's 3-2. It was the same. It's the same scenario. It's just been in and out. I actually have a short on here as well. Bear with me for a second here. And let me turn the shorts off. But you can see this is what I was talking about. You know, buy, sell, and no. Finally, it's got some traction. Whether we can get back up, there's a key number right here. Looks like we're going to try. We've gotten above that, so we'll probably get a right shoulder, and this will probably move up. There's probably a decent trade here from the entry, which was. Let me just see what the entry point is. I've got to. I've got to restore something so I can get another tool. But yeah, so this right here is high 43. This is the magic mark right here, 40.90. So we have been just above that. Today, Friday, we were able to get up to 41.40. So this is starting to show a pattern that will stair step up. On a weekly basis, you'll see a bit different pattern. But we got a big outside reversal. This is pretty important on this chart here, is that we got the outside reversal, we got new low. This is probably pretty significant. We'll see probably 42, and then ultimately move toward the 40-period moving average, which, if you recall, when I was discussing the S&P, that's the exact pattern they were looking for in the S&P as well. Yeah, and, Bruce, thanks for the question. I'll cover gold here in just a minute. Thank you. And so the patterns are unfolding on EM have a lot to do with the Dow. So let's just dig into that. Let's go over to the Dow, and then I'll do gold. And the Dow index, it's interesting. I hate to mention names, but Peter Schiff, who I don't think has been right about anything for about 10 years, is talking about the Dow collapsing because he's always long gold, because he sells gold. So this is probably the most bullish statement ever, having him on the negative side. But you can see the pattern. I've talked about this. This was the weekly signal on the Dow. You'll see way back at 90.58. We're now 96. So it's done pretty well, up about 8% from the entry. But this pattern is likely to continue. We still have some pretty positive PPMs here, which are telling us if we go over to the monthly graph here, this will give us a little more secular view. I don't think we're going to get through. Let me just draw a couple things in here. This upper range, which is around 98, my bet is that we stay in this pattern here, and maybe we get a little higher, but then you just end up working this range. And at some stage, I believe you go much higher. Now, whether that is the deal with China, because if you look at the yuan and some of the other currencies, the Dow is definitely dominant right now. So that's going to be a problem. And I just, like I said, I don't see this scenario where we're doing this. That would be the scenario where the Dow is going to implode. There are a couple things that could actually bring that into play, and I'll just talk about that for a minute. Is that let's say the Democrats take the House, you get in a stalemate, and there's games playing with the debt ceiling. We know that's always going to be an ongoing situation. So maybe they shut the government down, depending on what kind of pain that they want to impose. And regardless, it doesn't matter. But I mean, their strategy is resist and disrupt. It's not what's best for America. And so it's one of these things where, possibly we could see a big move down if the Democrats were to freeze the government. Who knows what all could happen. I guess there could be some negative implications. But if you look at, on this monthly graph, if you look here at the PPMs, I'll just draw them out. These things are most likely going to be sloping up a little ways, at least coming into their first and second derivatives. On the PPM2, we've actually gotten into through the second derivative, and from the PPM1, this thing's screaming. We're at 0.90. So there's a very strong, and that's representing that trend line there. I just put an arrow on. I'll bring that full screen for a minute so you can see it. But this is really the pattern that we're seeing unfold, and this thing is going to go higher. Like I said, whether it tops out around at this 98, 99, if we get through that, then we could go quite a bit higher. So let's go ahead and take a look at gold here. So let's go down and look at the short-term daily on the gold. This pattern is pretty corrective in nature, meaning that it is likely to come back in and test these moving averages. The good news is that when it spiked down to 1160, that was most likely the key low. I talked about that a number of weeks ago. And this may be the big hedge. I'm going to go over to the weekly mode here. And this is probably more evident as we come off of this low. Let me just draw this in for a minute. But this steep decline, I've talked about this before. Let's just roughly, didn't do a very good job at putting that out there. Let's just pick up this low, but this has pretty much been the range that gold's been locked in. So we'll call it 1370, 1160, so about a $200 range. And I suspect that we'll see this thing probably pull back just a little bit more, but I think we'll head up to the 1270 level. And then once that pattern is completed, then we could see this thing continue on. And I would, as I've said before, with this, I would wait, use whatever your favorite GLD or whatever you use for gold and just follow the signals on there, because from these levels, we're likely to see a pretty good move back into the upper part of this band that I just drew in. And that's highly likely that that's how this pattern is going to unfold. So this is weekly. Let's go on to a long-term monthly before we go on from there. Not sure. Sorry to flash screens around, but I have to go off one screen to get this to work. So this is actually I love this pattern. You guys know I've been talking about gold for a while. I still think this is probably going to be the place where we ultimately see $1,600, $1,800 longer term. But let me just draw in a couple of things so you can see exactly what I'm talking about here. So I'd argue from the 2011, this pattern that came in right here is this channel that's set up. That is what's referred to as this a diagonal fifth wave down. So you got 1, 2, 3, 4, and this is 5. Now what you get is, this is wave 1, and then you get this very complex A, B, C, X, A, B, and then C is completed. The next move should be, and I'll bring up some numbers. I'll stay conceptual here for a minute. But the next move should be for market to move higher. This is the long-term secular graphs. And there's some key numbers here around 1370, 1390. We get above that level, then the game is on. And this may be, if we're going to at least 2,300 on the S&P in this next sequence, there's probably going to be a flow of money going into gold. And that, like I said, I would play the GLD, I'd use the weekly models, and I would do all the trades. If you get a little whipped around in and out a couple times, don't worry about it. It's not going to be material. It's just going to be little whip in and out. And, we used to say a long time ago on the trading floor back in Pacific Options days, and, sometimes you got to do the trade 3 times to get it right. And you'll see sometimes VPM will get in, get out, get in, get out, and then the next trade is the good one. And please don't have the expectation every trade is going to be perfect. You're going to have these little nits. Like I said, on the emerging market, I've never seen, I went through a lot of symbols after reviewing them. I've never seen 8 losers in a row, and that's what we've had. So it looks like after 8, you're going to at least get 1 or 2 in a row, whether they're big winners or not. That's no way to determine that. But this pattern here is longer term, very bullish, and all kinds of stuff is popping up here. Sorry about that. But this pattern is very bullish. PPMs are still negative, minus 0.103, minus 2.4, and a plus on the ppm 3. So that's telling us that we should be able to get a pattern. You can see down here where my cursor is. Let me go full screen real quick. On this, you can see the ppm is turning up. The 40 is the ppm 3 is taking out its first second derivative, and we're likely to see that thing continue to move forward as far as acceleration. It tells us that we're going to move up above that average, and let me just get a value for you. That is 1279. So once we move above 1279, you're going to start looking at retracement values against this 1391 was a high. I said 70, but 1391. So let's just call it above 1400. This thing is going to move 16 to 1800, I believe. We may even retest the highs, and this may be the ultimate hedge. And I've said this over the last several months. If you're looking for an alternative sleeve, this might be the way to play this out, is to use GLD or whatever ETN or whatever gold symbol you want to use to play this. But this is definitely pretty big. So let's look at two things real quick. And both are more or less economically driven. This is the monthly chart of lumber, and this tells you a lot about what's going on with the housing. We've watched lumber prices drop from $550 all the way down to $297. So this is a massive decline. My guess is we'll probably stabilize here, but this is something that is telling you what's the underlying trend. Here's on a weekly basis. You can see how methodical this has been. We still have minus 0.25, minus 2.03, and minus 4.5. So all of the moving averages, all the trends are hugely down. Okay, so this is big, and it's interesting. This is a 200-week moving average. Look where this thing stopped, and I've been really observing all these 200-day, and we're looking at all this stuff trying to turn up. So maybe the worst of this part is over from the lumber standpoint, but we're looking at some massive downtrends here from the standpoint of the percent change on the downside. So these moving averages are going to supply a massive amount of resistance on the upside. So last, and we'll finish here, I'm bringing up crude oil right now, and this is the weekly crude, and we have basically crossed over. I suspect that we're going to bottom between 58 and 65. This is going to go into a sideways range, and I still have, when we go over and take a look at the monthly, I still have an expectation for this to move higher. So we broke through the 10-week, but after this corrective phase, I still think we can see the crude oil get up to around 80 to the 90 range, and then it will back out from there. But for right now, ppm 1's rolling over, but the others are still very positive, which suggests that that's these numbers here. I won't bring it up on screen. I'll just tell you what they are. They're pretty small. But we're looking at 57 to 55 on the downside. And that should be pretty much the bottom end of the range for crude. And then ultimately, it will move higher, just like what I talked about on gold. I think it's interesting that those two commodities, crude oil and gold, are most likely going to finish and start on the upside the same way. So I appreciate the question, and once again, please don't hesitate to ask questions during the show. And I will be up during the week for random meetings, and we'll make sure that you have a link and you subscribe so that you know when I come live. Because usually when I come live, I'll wait for a number of people to come up before I start covering anything. And like I said, well, we're going to be promoting this channel here in the next month or so, and so I'm looking forward to getting lots of activity on here. Anyway, thanks again for watching, and appreciate everything that you guys do for us. Thank you.